Happy Friday. I'm Keith Fitz-Gerald. Thanks so much for joining me. You know, markets are very funny. Just like that. Pow. All good news is actually good news again. U.S. payrolls jumped by 139,000 more than expected, while unemployment came in 4.2%. All three averages are firmly in the green as I record this. Now, the S&P 500, importantly, just nudged 6,000, which, to my way of thinking, goes a long way towards supporting the 6,500 to 6,600 year-end targets I see as finishing points this year. Now, investing is all about focus, not noise. So be focused. This isn't rocket science. Keep it super simple. Here's my playbook. Today, number one, Trump v. Musk or Musk v. Trump. I don't want to spend a lot of time on this for two reasons. Because A, there's no reason to, and B, I think that they're going to make up one way or another and probably a lot quicker than people think. You know what to do, I hope, because we've been talking about it a lot and for years with regard to event-driven situations like this. My take is that the Tesla sell-off is totally overdone. Now, OBAers, please keep an eye on your email for today's Ask Me Anythings, AMAs, because I will be addressing this situation in considerably more detail along with some very specific instructions as to what I think you ought to do about it. Keith's investing tip in the area, wannabes often focus on who's right. But you know what? The world's most successful investors typically focus on being profitable, often and even when they know they're dead wrong. Now, let's talk Palantir for a second. Here's another one I don't want to spend a lot of time on, but I do want to tell you I expect nothing less. CEO Alex Karp pretty much summed it up during a very pointed interview on CNBC. And I've got the link elsewhere on my channel and in the written version of the 5 of Fitz today. So click on it, watch it, find it, whatever you got to do. It's going to go a long way to allaying any fears you have. And while we're at it, batting 3 for 3 this morning, Chinese President Xi Jinping and U.S. President Donald Trump are planning to talk again and importantly have agreed to resume U.S.-China trade talks. That's a good thing, right? And to a point I made yesterday and when the whole tariff tantrum thing started, money always focuses on who's knocking, not just who answers. So think about this for a second, right? I mean, this is serious. If you are not investing, well, the chips are down and everybody's looking the other direction and they're scared out of their mind, you will, odds are, not be ahead of the game when they're up. Now, you know where to find me if you'd like some help sorting out the best names, why you want to own them, and a strategy that'll carry you through the noise like a hot knife cuts through butter. If you already got this covered, cool. Most investors don't. Number 4 today, layoffs are up, but that is not the real story. News sources are reporting this morning that corporate layoffs are accelerating and fast. Now, some of the names in the headlines are Procter & Gamble axing 7,000 jobs or 15% of non-manufacturing staff. Citigroup is apparently laying off 3,500 folks in China as part of a global 20,000 job reduction. Microsoft is trimming 6,000 roles across teams and geographies. Walmart, even Walmart, is slashing 1,500 jobs across tech, ops, and advertising. Disney, Chegg, Klarna, Amazon, and CrowdStrike, among others, have also made cuts. Now, if you're looking at the headlines, right, companies are basically blaming everything from tariffs and trade tensions to AI-driven restructuring. Now, the natural inclination for most people, including most investors, is to think this is bad. And for those who are laid off, that is undoubtedly the case, and my heart is heavy for anybody who finds himself in that spot this morning. But from an investing standpoint, this is great news, actually. And let me explain why. We've been talking for months about the real story isn't cost-cutting per se, but recalibration. America, and indeed the world, is entering a new era where efficiency matters more than expansion, which, by the way, is going to come next and again. From an investing standpoint, there are a couple things you want to do and think about. Number one, you want to avoid overexposed staffing-dependent business models. Number two, you want to watch for margin expansion plays, meaning that fewer employees tends to equal higher profits. And three, you want to stay alert to AI-driven enablers, i.e. the companies that are building the tools that everybody else now needs. Pay very careful attention while you're at it to something that I call return to scale, because what's happening is going to throw many value investors even farther for a loop than they already are. Now, I wrote about that in great detail in the December and January issues of One Bar Ahead. So if you're a newly minted card-carrying OBAer, please log into the portal and spend a few minutes reading both articles. I think you're going to find what I have to say there very valuable and potentially very profitable. Now, if you're not an OBAer, you're just going to have to take my word for it, or join the OBA family. I'd love to welcome you on board, as would every other OBAer who's already made the journey ahead of you, some of whom have been on board reading my work for 25 years or more, by the way. But that's neither here nor there. Point is, focus on where the company's going, where the world is going, not where it's been. And speaking of which, great company, Broadcom just turned in a double beat. That's number 5 today. Broadcom reported earnings beating both top and bottom line estimates, and I was thrilled to see the numbers. Revenue came in at more or less $15 billion, a 20% year-over-year increase. GAAP net income came in at just under $5 billion. Guidance was raised for Q3. I mean, great, and great. Should you buy it? Well, I get asked that a lot, and frankly, I don't see any reason not to if it fits with your risk tolerance, objectives, and circumstances, which I don't know, by the way. But personally, I prefer a few other names in the space because I think they're a better fit for me based on how I invest. But that's neither here nor there. What I want to impress upon you today is the exact same thing that stopped CNBC anchors Kelly Evans and Tyler Mathisen cold when I said it a few years ago, long before the thought had even recurred to most folks or let alone to the rest of Wall Street. And that is, AI will likely go down as the biggest investing theme in recorded human history. Every business on the planet will adapt, adopt, or die. And the same is true for investors. So it's critical that you get this into your brain and you start to take action today. Now, that brings up an interesting investing tip. Many investors wait for confirmation or simply because they're scared of what could go wrong, which means they're inevitably late to the proverbial party and they miss a lot of the big returns, right? But today's markets are about getting there first and planning for what could go right. And believe it or not, there's a lot of that, by the way. Now, speaking of what could go right, the fabulous, legendary Susie Orman has very kindly invited me back to her podcast this Sunday. I hope you can join the conversation for 2 reasons. Number 1, my bride and I listen regularly, so it's A, an honor to be on again, and B, something I encourage you to listen to because we're going to talk about some of these things plus a whole lot more perspective that could be very helpful and valuable to you if you're an investor trying to make your way through today's complicated markets. Bottom line, investing has never failed to produce profits. Ever. As always, let's make it a great day. Finish the week strong. You got this, and I will see you on Monday. Make it a great weekend. Cheers.